The final task in this chapter is to be able to describe the reporting of receivables on the balance sheet. Here is a sample of a balance sheet with just the assets section highlighted. You'll see the accounts receivable is listed, and below that we subtract the allowance for doubtful accounts, because this is the amount of receivables that we've billed for minus what we don't expect to collect will give us the actual value of receivables. The accounts receivable turnover measures how frequently during the year the accounts receivable are being converted to cash. This is very important. You may see this on the test. The formula for accounts receivable turnover is net sales divided by the average accounts receivable. So if we take a look at our example here of Federal Express Corporation, we're looking at 2006. So it does give us information from the previous year and for the next year. We want to calculate accounts receivable turnover for 2006. So we have to figure out the net sales for 2006, which we can see are $21,296. Accounts receivable turnover is net sales divided by the average accounts receivable. To figure out our average accounts receivable, you'll see the example, 2,860, our accounts receivable for the current year, plus 2,703, our accounts receivable for the previous year. Divide them by 2 to find an average. We have an average accounts receivable of 2,782. So our net sales divided by our average accounts receivable gives us our accounts receivable turnover of 7.7. Looking for 2007, it's same process. The average accounts receivable is what's different. We take our accounts receivable for the previous year plus the accounts receivable for our current year, divide it by 2 to get a new average accounts receivable. This turnover is going to be different because our net sales and our average are different. We take net sales of 22,527 divided by our average receivables of 2,145. We get our turnover of 10.5. Remember, the accounts receivable turnover measures how frequently during the year the accounts receivable are being converted to cash. So if we take a look back at 2006, it's 7.7 times. We look at 2007, it's 10.5 times. Do we want it to be higher or lower? You want it to be higher. The more the accounts receivable are being turned into cash, the more cash you're receiving. So the higher the net accounts receivable turnover, the more times it's changing from accounts receivable to physical cash, the better. So they did better in 2007. Number of days sales in receivable estimates the length of time the accounts receivable has been outstanding. So this is related to aging of accounts. The formula for number of days sales in receivables is the average accounts receivable divided by the average daily sales. So we can figure out how long it's been a receivable by looking at the accounts receivable compared to sales. So we have an example here, FedEx in 2006. Remember that the formula is average accounts receivable, which is given to us. We calculated that on our previous slide, divided by average daily sales. Average daily sales, we take our net sales divided by the number of days to get our average daily sales. So we simply take those numbers, 2,782, our average accounts receivable, divided by our average daily sales in 2006 to get 47.7. Looking at 2007, we go ahead and take our average accounts receivable of 2,145 divided by our average daily sales, again calculated by taking net sales divided by 365 days, we get 34.8. We want the average days sales in receivables to be small. We don't want a bunch of sales being tied up in receivables. We want sales to be cash. So the smaller the number, the better. Looking back at 2006, it was 47.7. In 2007, it's 34.8. This shows that we're improving on collecting receivables. Our sales stay receivables for fewer days and are turned into cash more quickly. The goal would be to be below 20. So we aren't at the ideal number yet, but we are improving. That concludes your notes.